words are really ugly.
So you need
He
to
won't
really
thank
bring
you
it up.
for it.
Bring it up, bring it up, bring it up. I don't mind looking stupid. I do not want to look ugly.
You don't want to have the nose shot.
No.
Great.
Huh? Well, I think eventually this video thing is mostly that my grandmother and my granny says, Granny.
Yeah, it's right here.
You should stand there so we can frame it up and then he doesn't have to.
That's the time.
You need to stay there. So we're framing you. Do you want to stand up there? Got loads of room to zoom in.
I do, yeah.
Make sure everything is tight so that it doesn't start.
Hello. Can I have your attention, please? Hi. Good evening, everyone. Thank you for coming tonight to join us for tonight's lecture from Meridian Chinese Studies. I'm one of the teachers from Meridian. My name is Jianling Shen. Tonight's lecture is being given by one of our advanced students. He has been with us for a number of years. In fact, he started his beginner's lesson in 2007, and he's now studying Chinese classics with our principal, David Su, from Meridian Chinese Studies. And without further delay, let me introduce you Aiden Kusanov.
Great. Yes, so I did start with Mr. Su 5 years ago, just as the credit crisis was about to unfold. And yeah, I didn't expect that as I would continue studying with him, I would find more and more different ways to look at what's going on in the modern world of finance through application of what he and I talked about in our regular classes. So I thought I would share some of that with you, and I very much hope that you will find it interesting, or maybe just, something different to look at the daily ups and downs of our financial markets. So the first slide you have there, they're not in any particular order, by the way, so it's not like one leads to another. The first line is the opening from Lao Tzu's, I think in English is Lao Tzu, Dao De Jing. It's one of the classical books. And it roughly translates as, that translation is mine, by the way, so it might not be, that without the final bits of it say that without desire one sees what is actually there, and with desire you see what you wish to see. Or the actual, I think the translation is that when you have desires, you only see what is on the edges of them. And the second line simply says that Lao Tzu presents the natural order of things, suggesting that we men take our clues from earth, earth from the sky, sky from the Tao, and Tao is, the law of the Tao is it being what it is. And that is very important, I think, in financial markets. So the next quote there is from Jesse Livermore. Jesse Livermore is a fantastic trader. He lived through the Great Depression. And back then, he made a fortune of over $100 million. And he started trading when he was 7 years old. He would go into bucket shops in Chicago and the Midwest and bankrupt all of these little trading offices and brokerages because he was always right about the market. And the way he did that is he would say, I'll listen to the tape. Back then, obviously, they didn't have any tickers, so all they had would be the telegraph, and it would simply, the kind of beep, 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 the tape would come out, and the broker would shout out prices. US steel at this price, this and that price. And so his wisdom, distilled through decades and decades of markets, is that a prudent speculator, which he counted himself to be, never argues with the tape, never argues with what actually comes out. The price as it is, the market as it is. Because he says, markets are never wrong, but it's an opinion. Opinions often would be wrong, of course. So quite often we hear people say, markets have collapsed, no one expected that, or the market is against me, I don't understand why market is going up or down, it shouldn't be doing this, shouldn't be doing that. And it very simply is quite an odd statement as far as he would be concerned, because market cannot be wrong. There is no reason why it's going there or here, much like the Tao. It's doing what it is doing, again, much like nature, but it's our expectation of it. We sometimes, obviously if we buy something, we want it to go up, and when it goes down, we think, oh, it's wrong. Well, no. You perhaps were wrong in buying it, and it is not wrong. Again, if we sell something, we hope to buy it again cheaper, so we want it to fall. If it doesn't fall, we build our expectation, and then it doesn't conform to our view, and that's what we experience as the truth. We think that we are the truth, whereas he says, both Jesse Livermore, I think, says, and Lao Tzu as well in this particular case, that something outside of there, in this case the market, is actually the truth. So we shouldn't argue with that. And I brought a few charts with me, and I hope, so we don't have a projector. Now one of them is, basically what you see here is a line that goes up and down all the time, is all you need to know really. It's not a straight line. It all goes up and down in a very defined range like that. And this is called the Citigroup Economic Surprises Index, and that's the story from 2003 to 2011, or 2012 actually. And that simply charts views of economists as they get disappointed with the coming data, and the line goes down, or when the line goes up, the incoming data from the market, about unemployment, about hours worked, about productivity, about all of these things, it exceeds their expectations. So as you can see, it constantly either surprises them to the upside or to the downside, and they never seem to be able to get it right, which is, again, what we experience, I'm sure. So all of us really wonder, how could all of these very clever people miss all of these crises? They missed the dot-com bubble, they missed the credit bubble, they missed the European debt crisis bubble, they keep missing everything. And that is nothing new. They never got anything right to begin with back from 1929. No one saw the Depression coming either. And I personally think it is because, much like Lao Tzu said, that when we have desire, we see what we want to see. Economists form expectations, so they think, okay, so the data will come out bad, for example. And it never quite comes out as bad as they think. So when it doesn't come out as bad as they think, oh, actually, well, it's not that bad, so it will come out better. But they don't stop there. They think it will come out even better and better and better and better, and build up their expectations. And the data, nothing changed. It still was, as it didn't come out very bad, it carried on not being very bad. But because their expectations have really, really gone away, then they start getting disappointed. So, no, it's just not getting any better. Well, it doesn't have to get any better, but it doesn't get any better. So they get really disappointed, and then their expectations fall, and then they think, oh, it's going to be really, really bad. But again, the data doesn't come out as bad as they feared, and their expectations shoot up. And the markets keep chasing after that, they keep running, and that's, I think, why we see this massive volatility. And practically, I think if we are aware of this, next time we see a very big decline or a very big rally, by rally I mean when markets go up, we will not be very surprised, but simply realize that markets, in fact, see what they want to see. So if we're just aware of that, we will realize that nothing is ever in the economy as bad as they fear or as good as they tell us it is. So, yeah, so we can move to the next one then. So the next one is the opening from Daxie, and that is, again, I suppose one of the classics. And I translated really the last bits, which say that, which begin with Daxie知道在 blah 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 在止于至善, which I think is a very interesting point, which I translated roughly as the way of great learning is in stopping, which is a great good. And then it goes on in a very Chinese way, so this then that, this then that, this then that. So if you know how to pause, then you can decide. Once you decide, you can be still. With stillness, you can be content. When you're content, you can have insight, and then with insight, you can get what you want.慮而後能得. And again, from Jesse Livermore, this ever wonderful speculator, he was even more impressive than George Soros is today. He said that his biggest profits didn't come from buying and selling and being always with it and calling and finding out new things. It came in the waiting. And another thing he said is that the biggest money he made wasn't sitting on his hands, not doing anything, because your hands always want to do something, and you always want to do something. And actually there's quite a lot of goodness that can come in not doing anything, particularly in finance. And I think particularly in finance, it's a very counterintuitive thing to suggest, because most bankers and people who work in markets, it will be a horrible thought for them that they could just take a break and the world won't collapse if they don't buy and sell millions of shares a day. And to that point, I think quite an interesting point to reflect on is, for example, the number of shares that daily exchange hands in London or New York has grown from a few thousand back in the 1920s to over 500 billion today. But the markets are no less volatile. They keep crashing as often and they keep rallying as often. The amount of information that we have today also far exceeds what we ever had. And yet our models are no better at forecasting and preventing these things than they have been 100 years ago. So do we really need to read as many things about markets and analyze and build as many models when in fact none of that seems to be helping? We're still getting massive, massive crises, especially in financial markets. And then also this is a very modern phenomenon, the average holding period of shares. Back a few, maybe 20 or 30 years ago, people would buy stocks and hold them for years quite often. And we call the average holding period would be maybe 10 to 12 years. These days, it's less than a week. So an average share, someone buys and sells it and buys it and sells it, and that generates a lot of activity. There's lots of stuff happening. You see these traders screaming and information down your TV ticker. There's always something moving along. But it doesn't make our world, particularly modern finance, any safer or any better. It certainly doesn't make people any richer, or traders any richer. So I think it really, I think this bit from Daxie where they say, when you need to stop first before you can really consider something. And I really do believe that in the world of modern finance, people who do, they have an edge. We say that, an edge in financial markets. When we step away a little bit and pause to think what's going on, we can really see the market for what it truly is, and that ties in with the first slide. I certainly feel it in my trading. I manage money. I've been doing that for over 10 years. That I call it clicking. I sometimes notice that my finger is moving just a bit too quick, and I'm clicking here, and I read a few lines, and I just click here, and I have 3 screens, and just think, no, that's not interesting. And then there's this, and then I think to myself, no, I'm clicking. I need to. And then I have to tell myself to step away from the desk and walk out of the room. And then in a few hours, you get clarity. which is also something that Lao Tzu said, that, how do you make a cup of muddy water clear? You leave it, and then in a few hours it becomes clear. So that's the insight from that line. I hope that's, again, interesting. The third one is from Confucius, and it's the Analect. And he simply says that when you make a mistake, don't be afraid to abandon it. Don't let it go. Don't be afraid to let it go. And that is a big, big, big thing for people who are in financial markets. They really like being right, because quite often if you're right, you make money, and everyone likes making money. And of course, that's one of the main reasons why people go into finance, is to make lots and lots of money. But of course, people also lose enormous amounts of money in financial markets. And nearly always, they lose money because they made a trade, they committed their capital, and they looked at the market and they thought, okay, so I'm making this trade because condition A has been met, condition B has been met, and condition C has been met. And then, for example, in an hour or the next day or in a week's time, they look at it again and they ask themselves, is condition A still in place? No. Is condition B still in place? No. Is condition C still in place? No. Shall I stick with this trade? Yes, I'm going to stick with this trade, because I hope it will go my way. So again, you form an expectation. Of course, you want to be right, and you've built up all this hope. And you're afraid that if you take a small loss, because of course when the conditions are no longer in place, that means that you've taken a small loss. I met a lot of traders, it usually happens to me quite a lot. We get so scared that if we take the small loss, it's crystallized. If you actually take the loss, that means that money is gone. While you're not taking the loss, there is still some hope, some chance that fairy godmother will come from the sky and she'll rescue the market and will move against all your expectations. Not so much your expectations, it will move against all the conditions that are there and do what you want it to do. So this massive $1 trillion market will do what I, for me, will want to do. And that's a very common feeling, that we traders get blinded by our desire, by our existing position. We get attached, we get too close. We are afraid to abandon our mistake. So I find again that in my daily practice of trading and investing money, I catch myself thinking, well, yeah, it's not quite right, but I'll leave it because I hope. I think, oh, no, ding, 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 wrong. If I'm hoping, that's the wrong thing to do. I really need to not be afraid to abandon my fault. So I find that particular line very, very useful for me. And there is a line again from Jesse Livermore. It's quite a long one, and basically comes down to saying that everyone who invests and who loses money, they only lose it because they hold on to their loss. They're really too scared to let go of a little loss, and that little loss becomes a bigger loss. But they're still too scared to say, okay, it's a bigger loss, but I should let it go because it could be bigger. And then it becomes a bigger loss, and a bigger loss, and a bigger loss. And so the saying in the markets is that the market slides down the slope of hope. You keep sloping, you keep hoping, but it's a slope, and so the market just slides and slides and slides, and you keep hoping and hoping that it will go higher, and it never does. Which is true, usually they don't. Yes, so that's that. The fourth one is, yes, that's also from the Analects. And there is another great trader who's called Stanley Druckenmiller. And he said that if you're going to be in this business and you think you know something, you think you really have an edge, you spend hours or days or months researching a particular circumstance and you really believe in this. If you really do, the last line is, you need to have courage to be a pig, what's called. You need to go all out. If you really believe in yourself and you really can tell yourself that this is what it's going to be, then you go for it. And it takes tremendous conviction to do that. And much like Confucius said, shall I tell you what knowledge is? Knowledge is in when you know something, to really hold that you know it. But if you don't know something, then to tell yourself, actually, I don't know it. So being honest with yourself, I find in this particular business, when it's always a matter of losing money, and again, no one likes losing money. There come points when you think, well, everyone says, for example, that it's going to go down, but I really think that it will go up. And you need to really search inside yourself and think, do I really think that? Or maybe. But then, and it's called the sleeping test also in the markets. They say that if you can go to bed and not worry, that means you really know it, so go with it. But if you go to bed and think, oh no, it's not, oh no, then probably there's something wrong, or your position size is too large. So that helps me quite a lot. And also, obviously, in life, not just in financial markets. I think generally it's quite a curious thing to apply Chinese philosophy to financial markets, because a lot of what Chinese philosophy for me deals with is emotion. And money has, obviously elicits in us men a lot of emotion. We all like money, no one likes losing money, everyone wants more money. So there is desire, there is hope, there is fear, there is anger, all of that ties in with money quite a lot. And Chinese philosophy dealing with all of these things of confidence, anger, fear, sadness is quite a helpful way to observe yourself doing that. So after that, we go on to, that's also from the Analects, and it's a very, so I have two quotes there from both of them American traders. One of them again is from Jesse Livermore. And he says that the speculators, so yes, I'm a speculator, or any trader, anyone in the financial markets, their chief enemies come from within. And yes, they do in fact come from within. It's hope and fear, or greed and fear in the current setting. And there is an expression that markets are driven by greed and fear. I think incorrectly, but a lot of modern media blames this last crisis, under which the shadow of which we all still live, on this unrestrained greed of bankers. I don't think that's correct, but anyway. So greed, particularly in markets, plays a very big part, and it affects all of us. It certainly probably affected all of you with mortgages or credit cards, or cuts, or anxiety about what will happen to our economy in the aftermath of this big crisis. But then market participants also think of themselves, and certainly they build models that are said to be not affected by greed and fear. Of course, bankers will never say, they say we put in millions of dollars to develop these econometric models that have lots and lots of numbers. There is no greed and fear. It's all numbers. Numbers don't feel anything, and when something goes wrong and the model didn't predict it, well, we'll create another model. So they don't really look at greed and fear, I think. They think, in other words, they're firm and unbending. They think that their models are correct. They really like saying that. They think that they can quantify risk and predict, in fact, bad outcomes. I don't think they can, and they can't really pronounce themselves as firm and unbending, because they really are under the influence of their passions of greed and fear. And Bob Farrell, he is a very, very famous, his career spans over 6 decades. He was a chief economist at Merrill Lynch. He left before Merrill Lynch went bankrupt and was bought by Bank of America. He had 10 rules of investment. One of these rules was fear and greed are stronger than long-term resolve. And he also applied it to the long-term investor. We all want to be long-term investors. We all buy stocks, probably a lot of us, for our pensions or for our children's education. And we think, I'm a long-term investor, I'm a long-term investor. And you buy something at $100 and it goes to $150. You think, oh, that's great, but I'm going to really hold on to it because I'm a long-term investor. And then it falls to 140, you think, oh, well, it will recover. Then it goes to 120, you think, well, it's still above where I bought it. And then it goes to 80, you go, I'm a long-term investor, it's going to go. Then it goes to 60, oh no, I lost 40%. And it goes to 40. Oh no, I have to hold it now. Can't sell it. Obviously, you know, I'm losing 60%. Then it goes to 20, and you think, oh God, it's just. And then it goes to 19. You think, that's it. Get me out. 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 Sell, sell, sell. You don't want to have anything to do with it. So you sell it, and then invariably, when you sell it, that's when it goes up. And that is what happened in the dot-com bubble. You know, I don't know if any of you did speculate in the markets. We had wonderful companies like Microsoft or Cisco, Nokia, you know, all of these, Amazon. Microsoft went up from $40 to $450, and then went back down to 60. So, you know, obviously someone was selling all the way down. They sure as hell did not buy it at the bottom. So fear and greed really are stronger than long-term resolve. And that has also been highlighted, obviously, by Confucius a very long time ago. So I think that for us, when we deal with modern financial markets, we just need to be aware that we are under the influence of our passions, and we're not firm and unbending, and therefore we need to behave accordingly. And especially when we're dealing with money, we need to acknowledge that when the crisis comes, almost no one will be firm and unbending. Then we have slide number 6. And the quote there from Bob Farrell is that there are no new eras, successes are never permanent. And Jesse Livermore, again, this wonderful trader, he said there is nothing new on Wall Street. Everything that happens in the stock market today has happened before and will happen again. And I think that's very, very true. This is the chart of the Dow Jones Industrial Average. Yeah. Leading up to 1929, the famous peak, the Roaring Twenties, everything was absolutely fantastic. So it went back up almost to 3,800. And then it collapsed and lost almost 90% of its value, back to 600. And you know, obviously everyone back then said never again, never again, never again, never again. And so then we had the NASDAQ 100. That was in the year 2000. It went up, and new eras were pronounced. Information technology was going to make us all rich forever, and computers were going to change everything, and we will all always be rich. Went up to 4,750 and then promptly collapsed back to 1,000. So that was 75% of its value. And no one talks about it now, of course, because, you know. And then this was only a couple of years ago, the Shanghai Composite Index again. It went in China from just over 1,000 to 6,000. That's an astonishing 600% rally. And, you know, China was going to rule the world. It was going to overtake America. There are a billion new consumers. You can never go wrong. Buy, 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 buy. And then I remember one analyst back right about here said, you should be buying Shanghai now because the Politburo and the Chinese Communist Party will never let the market fall. It's an interesting reason, but anyway. So it did promptly fall from 6,000 back to 1,750, almost 66%. So all of these things happen, they will happen. There is nothing new under the sun, I think. But we must be aware that bankers are very often will tell you that this time is different. You know, this time you must buy Apple, for example, because Apple is a truly revolutionary product. It went up in price from $80 in 2008 to $700 in a couple of weeks ago. And it's really a new era, you know. This time it will work, so please don't believe it. If ever anyone tells you that, again, there is nothing new under the sun. I'm sure Apple is a great company, but our expectations are so far now that it probably will go down to $200, and a lot of people will lose their money. And no, I was not born with this knowledge. I'm just fond of studying ancient charts, as you can see, so it all happened before. So that's that. And then we have number 7. And that's actually, if you just go into number 8 instead, the last one. And the last one is an interesting point for me particularly, and it's about the reason why we traders do what we do in markets, and Of course it is to make money, we want to make a lot of money. But I found in my practice that sometimes when I really want something from the market, and maybe I feel bad, I had a couple of bad weeks, or I had relationship difficulties or something like that, I think, I just got to make a bit more money and then I'll feel better. Come on, market, make me feel better. Give me something. You got to help me here. And then I make usually stupid trades and then I lose money invariably. And there's a little story from Jesse Livermore there about. No, that's just actually the sum up. The story is that he was working in this big office and a very confident guy comes in and says, "There is this wonderful fur coat and I want to buy it." Well, how are you going to pay for it? Well, market will pay for it. So he made a few trades. He was trading to pay for his fur coat, and obviously he lost money. Then the next trader said, "I'll buy it, and I'll make the market pay for it." And again, he lost money, because he really wanted something. He wanted the market to give him money to pay for his coat. And then a third trader and a fourth trader, and then Jesse said, "Look guys, I'll buy this coat so you don't bankrupt the office." He bought the coat and no one could have it. And that's very dangerous when we go into the market expecting to make a quick buck. We usually have that thing about the first slide. We have desire, or I have desire, a trader. He wants the market to either make him feel better. Yes, you're very clever. You've done well. Here is your reward. Or we just want money. I want to buy a new TV or a new car or a new house or something. And if that's what you want, then all you will see are great trades, because obviously you want to make money. So, "Oh, this is great, this is great, this is great." In fact, there probably aren't good trades, but you are seeing great trades because you're blinded by your desire to make quick bucks. And whenever I have that, I've always lost money. So, and I think that the first line is that, so what things that are difficult to get, I suppose luxuries, make men behave in inappropriate ways, which they do, and that's why a smart man looks after his stomach and not his eyes. Which I think, again, markets actually are quite mundane. There is not that much excitement if approached properly. It's just a job, and they will never actually give you what you want, all these wonderful rewards and houses and make you feel better. I think quite a lot of what this crisis is about is to show that, in fact, in excess is not where really good lies. And so the other line I put there, it's from Bauza, I think that, from Bauza, that the smart man walks away from too much effort, because when you really want something, you're clicking, trying to get there, but it's usually never there. You can never get there. Or extravagance, or easy indulgence. And the last one is, again, by Bob Farrell, and he simply says that excess in one direction, what really goes up, always leads to excess in another direction. It will always come down, it will come down further than where it would otherwise stay without this massive up thing. So if anyone is ever investing and things are going spectacularly well, generally, 99 times out of 100, it's better to get out then, because if you don't, then it will go spectacularly badly. That's usually how it works. And the markets always look for, the other line here is an average. And they do generally, if they go way away from the average, they do eventually come back to the average, but as you can see, they usually always overshoot on the other side. And all of them are like that. They go up a lot and then down a lot. So they never really stay at this average, or the golden mean. And I think it's quite foolish, again, studying just from history, it's foolish to expect that the market will stay in the middle and behave nicely as we expected. Because, as Confucius has said, anything can happen, there can be peace under the sky, and we can reject all the wonderful things and walk on naked weapons, but the median way can never be attained to. And I think it's a lovely line as well, that when I get really worried or stressed about something that I can't seem to make anything right and I'm all over the place, I think, well, actually, 중용 부크능예, so I can't get there anyway, so there is no point in trying. So that's it. If you have any questions, I'm very happy to answer them.
We're going to have a break for 10 to 15 minutes. Then we can leave you to have your thoughts ready and your questions ready. So after the break, then we will take your questions and share your thoughts. And we'll have tea there, so you can have some Chinese tea.
Thank you.
Thank you.